the absolute most important charts in the world really to understand. GDP growth is driven by this magic formula, which is debt growth plus, well, debt growth plus population growth plus productivity growth. That's how you drive trend rate of GDP. Now, debt growth's gone to extremists, and now really we're just servicing debts. Basically, GDP keeps falling, and it's falling over time, the trend rate of GDP, because of the magic formula. And Julian, if you can get to the demographics charts, because they're the key ones here. The issue is here, the biggest secular factor in all of markets is this one thing, is the aging of population. And we can see the births rate is falling in the US, much faster elsewhere. So that obviously is a function, the labor force participation rate, the size of the workforce, is a function of births, deaths, or the number of people being born, whatever, right?
Raoul Pal emphasizes that demographics are the most important factor in understanding global markets and GDP growth. He explains that GDP is driven by a formula, debt growth plus population growth plus productivity growth. However, debt growth has become extreme. Most of it now just services old debt. As a result, GDP growth is trending lower over time. The core issue, according to Pal, is the aging population. Birth rates are falling rapidly, especially in the US, and this decline affects the labor force participation rate. Fewer births mean fewer workers, leading to slower economic growth. Pal stresses that this demographic shift is the biggest secular force driving markets today. Let's dive into the charts and hear more from the interview.
And you hear the phrase demographics are destiny. They are, until the AI and the robots come, which are basically artificial humans. This is the problem that faces us all. But there's a way that they've got around this, if you go to the next chart, is they've increased government debt to offset the declining growth from the population. So part of the magic formula was the debt growth and the other was the population growth. So they've used debt growth. This chart, nobody understands, and it's never been copied on X, which is the bizarrest thing because it's the most incredible chart of all, which basically says that all government debt growth is basically a function of labor force participation rate. What's interesting is then, okay, so the debts keep going up. We know the forward look of where the labor force participation rate is going to go, and how it's being funded is liquidity. This is Fed net liquidity. You're probably better to use US total liquidity because that includes the private sector because they're now using the banking sector. So what they're doing basically is debasing currency to pay for the debt. It's as old as the hills. It's as old as the story of economies. It's as old as the story of money. And it's happening at a very pernicious rate of 8%. So you kind of notice it, but don't notice it. But what's happening is asset prices keep going up optically because the currency is getting debased. Even if you look at real estate adjusted by the debasement by liquidity, it's basically a flat line. But wages are a variable input. And so what you find is that wages do not account for this. It's also the same factor that is driving PE ratios that drives everybody nuts. Why are PE ratios going up over time? Because the P goes up because of debasement. The E is a variable and doesn't. So it always goes up in line with debasement. And we've shown that over time too. So this is the really big picture of what we look at. It allowed us to understand there's only two assets to own. And then we got to a further realization, which is, okay, if everything, 97% of all of NASDAQ's price action is driven by debasement, it's the strongest factor we've ever had in any macro regime in history. Okay, great. That makes macro super easy. For crypto, it's 90%. So we've basically got a factor that's so powerful that nothing else matters. Brilliant. So then let's take the NASDAQ. If we've got one force, one economic force, we take the NASDAQ, we divide it by by Bitcoin, it's down 99.97%. So you kind of get one asset allocation only, which is crypto, which is bizarre. In a macro world, we now think you need concentrated portfolios as opposed to diverse portfolios. In fact, diversification just destroys returns now because you've got one clear macro factor.
Raoul Pal explains that demographics have traditionally driven economic growth. But as population growth and labor force participation decline, governments are compensating by increasing debt. This rising debt is now being funded through liquidity injections, effectively devaluing the currency, a classic form of monetary debasement. This debasement is subtle, around 8% annually, but it causes asset prices to rise nominally while real wages lag behind. It also explains why price-to-earnings P/E ratios keep climbing, because prices rise due to debasement while earnings don't keep up. Pal reveals a critical insight: 97% of NASDAQ's price movement and 90% of cryptos are driven by liquidity-driven debasement, making it the dominant macro force today. As a result, he argues that traditional diversification no longer works in today's environment. Concentrated portfolios in crypto offer the best returns. He concludes that when you compare the NASDAQ to Bitcoin, the NASDAQ has lost 99.97% of its value, highlighting crypto as a superior asset. Let's pull up those charts and hear what Raoul Pal has to say.
I think so. And, Lynn Alden's statement of nothing stops this train becomes truer every day, because the US government paid lip service, or at least tried to do something, at least pretend to look into doing something about debt growth.
Yeah.
And even Elon, who can solve going to Mars, can't fucking solve this. So It's like game over. I mean, that is never going to get solved. So this cycle is going to continue, and it has to continue. And the issue is right now is interest payments are at this level and GDP growth is still at this level. So there's not enough GDP growth to pay the interest payments. So the interest payments keep compounding, which is the thing that everybody picked up like Elon did, which is why Scott Bessent, everybody's screaming to get rates lower, because it's causing a problem. You can see it in ISM. We've had this weird bifurcation where GDP growth's relatively high, whether that was the hangover from the immigration, the government spending, other stuff. But ISM, which is the guide to the business cycle, has been the longest ever level at 50 or below. So it's telling you that there's a big core part of the US economy that's just not functioning because rates are too damn high, because there's a crowding out from these interest payments, right? This is the actual issue that the Everything Code goes through. That has to get solved. If not, the economy can't go. From a different perspective, but he's like, I don't think there can be recessions again. And Julian and I took that back to Julian and said, look, Julian, there's something sticky in my head. And he had this yelling quote. And it was one Saturday when we were writing GMI. We just threw this around and we're like, most recessions are basically credit events. And normally it means the collateral has fallen and it's getting called upon. So the collateral doesn't cover the cost of your debt. That's generally what happens. But once you debase the currency, the collateral can't. And I learned that lesson in 2020 when it all started happening. I was like, what the fuck is going on? Where's the insolvency trade that I thought that was going to happen? And then I realized we can't have a credit event. We can't really have a recession because of what they're doing. It doesn't mean...
I think also the economy shifted too, right? Like we're in a highly service-based economy, and like, tech and everything where so much of the growth comes from is not really cyclical anymore. Like it made sense when we were just a bunch of factories, right? And you had to lay people off, you had to buy less goods and all that, and you could see the flow of the cyclicality. But in this tech world, in this AI world, it's not really cyclical as much anymore.
Although,
so
the ISM still works pretty well against GDP. So people have argued that for a long time, but I'm like, I look at the ISM manufacturing and it still works pretty well. So it's not decoupled per se. I just think that recessions the business cycle is driven by the credit cycle. And now it's just the liquidity cycle, because the credit side of the equation can't go bust because they can't allow it. The system's too indebted to allow the collateral to go down because everything's over. That's all the people who say they should just let it all burn. They're like, you have no fucking clue what it means when the world is 400% of GDP in debt. Yeah. What are you going to do? Write every single asset, everybody's savings down by 90% and say, okay, there you go. You got your reset. Never going to happen.
Raoul Pal emphasizes that the U.S. debt crisis is now structural and unsolvable, with interest payments rising faster than GDP. The system is trapped. Even Elon Musk sees a danger, calling for rate cuts as high interest rates begin to choke the economy. While GDP growth may appear strong on the surface, indicators like the ISM Manufacturing Index show deep, persistent weakness. The real issue? The economy is too indebted. to allow a normal credit-driven recession. If collateral values fall, the entire system risks collapse. So instead of letting the system default, policymakers resort to monetary debasement, silently inflating away the debt. We've shifted from a credit cycle to a liquidity cycle, where currency devaluation replaces default as a pressure release valve. In a tech-driven, service-based economy, traditional cycles are breaking down. But one thing remains clear: a full financial reset isn't coming because it can. The stakes are too high, with global debt sitting at over 400% of GDP. If you want more breakdowns like this on how macro forces shape crypto and markets, don't forget to like, subscribe, and turn on notifications. We dive deep so you can stay ahead of the curve.